Hello and namaskar. This is Neeraj here, and welcome back to my channel, Financial Market Analysis Twist by Neeraj Shah. So, in today's video, I would like to discuss regarding the basics of investment in stock market. Basically, how to pick up and what to look, which are the parameters. So, before starting, thank you very much to all my subscribers, and also request you, if you have not yet subscribed, please subscribe to my channel. That will give me a lot of encouragement also if more and more people join and get benefit, because my channel is not the usual stock market investment basics idea channel. It's a different from all the formats, and I come out with the very different kind of insights into the sectors and predictive analysis, and which makes it a very different, and also have a different format regarding where the stock specific analysis, multi-bagger stock specific analysis. I come out with the specific stock video, which is available only for a very nominal charge of 1,000 rupees each video. So each video is 1,000 rupees. So there are three already. I have come out with the premium multi-bagger stock ideas, which have done fantastically, which have outperformed the market, and still it is very relevant kind of a stock investment. Still I would recommend that. So if anybody is interested, my email details are in the description box down below. They can write to me. I can send them the bank details. You transfer the 1,000 rupees, and I just send you the link. It is customized link. So without wasting much time, so what is the basics of the fundamental aspects of the stock market investment? So the first and foremost is that you should only invest that much money in the market which you can kind of spare it. In the sense, it is not for your day-to-day basics, or even if you don't need in the near future. You are basically doing investment for the long term. So you are building wealth. So that is the difference. Stock market, if people say that you come and do trading, okay, that is another aspect of this thing. That is a daily, if somebody wants to daily earn, that I am not into. Basically, the stock market is for the wealth buildup. So, slowly you build up your wealth over a period of time, so that wealth, that investment can be used for buying assets like home, or buying or for your some educational expenses, or for some investment in the business in the long term. So this is how your wealth is built. So that is the first and foremost. And some of I request everyone to watch till the last, because I may be telling the fundas which you will not find in any books or in any of the channels. These are all from my own experience and my own years of research and interactions and observations into the real world. So that is the first thing, is that you invest. Suppose you are earning say 50,000 rupees per month, or 50,000 rubles, or whatever it is there. Out of that, suppose your everything, expenses and everything, is say 35,000 or 30,000. So you are invest 20,000 rupees you have saved, means kind of saving. So as you are young, you can invest more into the stock market portfolio. So you can say that out of 20,000, 5,000 you can always keep for your emergency. 10,000 you can always keep for your emergency, because emergency expense can come anytime, any day. Suddenly some illness has happened, accident has happened, suddenly somebody needs, your brother or sister or your family or somebody, some expenses can come. Somebody, suddenly you wanted to go out somewhere. So out of that, so 10,000 you keep for that, liquid always in the bank, so that you can anytime withdraw and use it for your expenses. And another 10,000, which you may think that you don't require it much. So that is what the 10,000 only should be, kept for the stock market investment, which you don't need in the emergency. You are using it for the long-term wealth build-up. So that is the first rule, which you will not find anywhere in any of the books, that you should only invest in the market, which is kind of, you can forget, it's not your for emergency requirement. Second is, now how to invest. The general rules are that you open a demat account with any of the stock brokers, online or offline. Okay, and that where you will start, you can have a account, and they will only open the DP account also. It's like bank account, but where shares are kept in the digital form. So it is called DP account, and that is available. You can find it. This thing. So that is the second step. The third step is what investment. What to invest? Okay. Now this is a very tricky part. You know, people 90% of the people will go for this technical chart analysis. They study and they read and they go for the trading. So I am not into that. So I will not. I cannot tell you anything about this thing. But another option is to go for the investment, as I told you, that long-term fundamental investment. So how to go about it? So suppose you have so many plethora of stocks are there, like 5,000 stocks. So out of that, to start with, you can go for that your that index stocks, be it say S&P index, be it say NSE Nifty 50 or BSE 30. And what you look into this thing, and you look into the sector wise, these stocks are there. Okay. So what are the things which you should look into any of this thing is, first of all, there are many websites where you can say NSE, BSE websites, Yahoo Finance is there. Then there is a website called Rediff. In that you can find any of the company which you like. Say suppose XYZ company you like. So once you have identified some company or some sector, then you should do the fundamental research. Now how to do the fundamental research? So a very basic and very simple things I will tell you. You don't need to go much into this. You look at its PE. What is PE? Price to earnings. So what is price to earnings? Price to earnings is the ratio of the price of the stock at the current market price is 100, and E is EPS, earnings per share. The earnings per share also you will find in any of these sites, and also on the annual report you can go and study. So that is the first one parameter of looking at the stock, is that price to earning. So lower the price to earning, then we can say that this is a cheaply available stock. Fundamentally, if it is fundamentally good. I am not telling that this is the only way criteria, but this is one way of look, is that PE is low in say say single digit, or even in double digit, to the lower decimal of double digit. So you can say that PE is 10 only. Oh, okay, this stock is cheaper. When you have to look into the sector wise also. If the sector's general PE is how much, you will all get this on the website. So you can always get it. Let's say metal sector or steel sector, commodity sector, or banking and financial sector. What are the PEs? So this is one of the criteria of looking the PE, price to earnings. And how to get the earnings? EPS. EPS is your profit of any company which you see, divided by the number of shares which that company has into the market. So which you can find from the annual reports, or from the balance sheet of that company, from that website, or from any of these sites, as I told you, BSE, NSE, Yahoo Finance, or any of the sites for that particular stock which is listed in which stock exchange. From there also you can get. So that is one thing of, and the second criteria, second parameter which you can look at is this thing, price to book value. Also people look at this. Price to book value is generally for sometimes the stocks have run up, and what is price to book value? Price to book value is the price divided by the book value of the stock. How to calculate book value? Book value is calculated by dividing net worth of the stock. Net worth of the stock divided by number of shares. What is net worth of the stock? Net worth of the stock, you will go to any of the company's balance sheet. You look at on the liabilities side, you could look at what is the shares, capital and reserves. So which that heading, you total reserves and the share capital. You total, that is the net worth. That will give you the net worth. And you divide it by the number of shares. That will give you the book value. So what is the meaning of price to book value? The meaning of book value is that if I would bring, if it is, say, suppose price to book value at 1:1 only, that means that this stock is available, this company is available at its it's at its book value, which is very good. Or if it is available, let's say price to book value is 3. So that means if I have to set up this company at today's time, in today's value, I have to give 3 times more. I am giving 3 times more for buying this company. If company would have been set up, it would have been set up at X price, but if it is now price to book value is 3, so that means it is available as 3x price, 3 times. And if the price to book value is less than 1, that means it's very cheap. Because if I would have been setting up a steel plant, I would need 100 rupees suppose. Then if the price to book value is less than 1, that means it is, say it is 0.7, means I am getting this steel company at 70 rupees only, which in today's term, which in actually if I would be going to set up a steel plant in today's, in actual term, I would have to invest 100 rupees, but instead of that I am getting 70 rupees. I am getting that company for 70 rupees. So it is a great value. So this is how to look at the price to book value also. And that the same way price to earnings means you are giving for, if suppose price to earning is say 20, if some stock is at price to earning of 20 values, 20x. So you are giving 20 rupees to get the 1 rupee profit or earnings from that company. That is called price to earnings. And this price to book, as I told you just now, this is what the price to book values, meaning of the price to book value. That's why it's important. Then the third and the most important for the commodities and the capital intensive industry sector, stocks which are into capital intensive, which companies are which are capital intensive, and commodities which require a lot of capital to establish, an asset heavy, asset rich industries, right? Like say metals, like say chemicals, fertilizer, oil and gas, refineries, power sectors. So these are the capital incentive industries, right? So this is where I would suggest, this is my own research and my own preferences, to value all this company, one should look at EV to EBITDA. That is another valuation parameter which one should look at it. So what is EV to EBITDA? EV means enterprise's value. What is enterprise value? Enterprise value is nothing but the sum of your market cap of this company, total market cap, which you know, market cap is number of shares multiplied by market price, that is market cap, plus you add debt or loan, whichever the total loan company has taken, which you can find from the balance sheet, the total borrowings or loan or debt, whatever you call. And from this you deduct the cash or the equivalent of the cash balance and bank balance which company is holding in its balance sheet, which you can find. So that will give you the EV, enterprise value of the company. Okay, and that enterprise value you divide by Ebitda. What is Ebitda? Ebitda is earnings before interest, depreciation and tax. So basically it is, you can find from any of this P&L, any of the companies, you say that what is the operating profit, whatever the revenue minus this cost, that material cost, raw material cost, employee cost, all kinds of sales and general medical, only you don't have to take depreciation and interest and tax. So whatever you get, that profit or earnings before depreciation and interest and tax, that is called Ebitda. So this gives you the earning ability of the true earning ability of the company, because Ebitda is your that margin, how much on that operating level, gross level, this company is able to make the margins. Okay. So EV/EBITDA becomes very successful or very useful in evaluating this cyclical or the capital intensive industries and commodities and that kind of metal industries. Why? Because it's in cyclic industries, not necessary that suddenly price fluctuations is very high, and that is why many a times it happens that when the cyclic industries in Islam, because of the capital intensive nature, you have taken a lot of loan also. If some company has taken a lot of loan, so you have a very high interest expenses to pay, and depreciation also, because capital intensive is a huge asset rich, so the depreciation is also there. But depreciation is nothing but a nominal charge we take. It is not the actual cash outflow. Okay, so that is the reason you have to calculate. You don't have to take this into account, because when take this into account, it may happen that at the PAT level it may show losses, but it may not be that. That's why for capital intensive industries, commodities, cyclical, global industries, it is better to look at EV to EBITDA. That is the ratio. So this is how to calculate EV and EBITDA. And EV, as I told you, that market capital plus borrowings or the debt of the company, and you minus from that what is the cash holding of the company. That will give you. So anything less than 10 in current times, any company of this cyclical intensive industries, capital intensive industries of metals, oil and gas, commodities, this, I'm not talking about defensives like FMCG and banking and financial, which we don't value those companies on this, but this is a classic parameter for evaluating any of these capital intensive industries. And look at this, and then you take your decisions. Then I'm not saying that just look at this, but these are some of the things, these are the three basic things you should take a look into while evaluating any company. And then this is when you have to compare if the peer comparison is also available. So which are the other companies in this particular sector? You look at them, at what the PE, PB, price to book value, and EV EBITDA they are trading at. And then you, of course, nobody knows, because whatever is you see, it is all historical figures, right? So that is just what has already happened. That doesn't mean that it will happen like this way, because future, that is where the art. So the stock market is nothing but art. It's not science, but it's more of an art, because figures are everywhere, data is everywhere, it's available. But how you interpret that data and how you interpret that data for the future, that is where that one can be a successful or a loser or the unsuccessful investor, or you don't make that much money, or you don't identify. So these were some of the basics which you have to do your, of course you have to do your research and basic research, but that is where the experts or the analysts like me come into picture, and which you can give you more in-depth and logic about that, why and what is the futuristic probability of such a sector. But for your own consideration also, for one own self starting, these are the basic steps to look into the stock market investment. And also the third point in today's video, I would not like to make it very long, is that you should have a portfolio of not more than 15 to 20 stocks, and slowly, as I told you, that it is as if you 50,000, 10,000 you are putting every month or whenever you are, which is disposable, in the sense you don't require it for emergency or for the near term purpose. So that is the only money you should invest in the stock market, and that's how you have to build. But you should not invest more than 15 to 20 stocks portfolio. If you are diversifying too much, it's like this way, you are spreading a chapati too much, it becomes thin, like paper. If you are pressing it, so if you are diversifying, if you are spreading it over a huge area, so it's more the stocks you are spreading it, like your money you are spreading it, you will get very average or below average kind of returns. So this is the third which I wanted to tell you, this law is that you should have investment of only 15 to 20 stocks. You can churn. Say suppose you feel that some stock has outlived and given enough returns, and you don't see much future probability of going much higher, but you see another stock which maybe now is the time to buy and it can become very high market, so you sell that and you buy that another stock. So like that way you should try to manage this. This is the some of the, of course, all the details which we can't discuss it here, and that is where, you know, if anybody wants on the paid basis, we come out with the videos, or even if somebody wants to consult me for the investment, you know, it's a paid basis, we can have this kind of one-on-one discussion. You can always contact me for any questions, and just we will take up some more other basics, but which are not usually available anywhere in the books or anything. So some more tidbits about the basics some other time. Till then, ciao from Neeraj from Moscow. Love you, and stay, make money. Everyone, I wish a lot of money and a lot of success in the stock market investment. That's it.